As a source of inefficiency, our laissez-faire financial markets generate real interest rates that may be inefficiently high. This type of market overvalues the present and undervalues the future. This is referred to as myopia or short-sightedness. According to a publication of interest rates and bank charges for personal and other retail accounts compiled by the Bank of Zambia, as of June 30, 2019, First Capital Bank was the most expensive lender of credit, charging an annual interest rate of 32% among all the 18 commercial banks in the country. Take note that the central bank's monetary policy rate, the MPR, was at 10.25%, making First National Bank's margin 22% above the benchmark lending rate. Zambia Bank Limited was the second most expensive lender, charging its clients an interest rate of 30.75% for a salaried-backed loan. First Alliance Bank Zambia Limited was charging clients an effective annual interest rate of 30% on salaried-backed loans, with its margin above the central bank's MPR rate of 24.5%. Keep in mind that the lending rate threshold was 30% during this period. Despite all this, the Bank of China charged the lowest lending rates on salaried-backed loans at 10.25%, though it's questionable who and how many people were given these loans at this rate. For mortgage loans, Stanbic charged the highest at 26.75%, while the United Bank for Africa, UBA Zambia Limited, was the cheapest at 15.25%. In terms of lending rates on loan facilities for small to medium enterprise, SME sector, AB Bank Zambia was found to offer the highest rates at 77.63%, while FNB Zambia was found to offer the cheapest at 24.5%. According to Bank of Zambia data, commercial banks' nominal average lending rates rose to 25.4% as of June 30th, 2019, from 24.6% in March of the same year, 2019. According to SIEC data, the United States of America bank lending rates were reported to be 3.25% per annum in May 2020. Zambia has a mixed economy where government has less control and markets operate independently. A mixed kind of economy structure continues to sweep across Africa, Asia, and Latin America in the last few decades. However, for a small and poor economy like Zambia, one wonders what good the free market economy has brought to its citizens. We should swiftly shift to more capitalistic characteristics in our economic model. Let's embrace the USA and German economic models. If the general bank lending rates in the USA are below 5%, why should Zambia's lending rates be above 30%? There is a more damage and harm that is caused by such high lending rates in the country to both macro and microeconomic levels. Therefore, it's important to take keen interest in the following economic solutions from our economic point of view. Government should not dictate interest rates, but should positively influence the rates of interest. Each lending and borrowing pair negotiates their own rate, and the average of these is then calculated to produce the central bank's lending rate, which in turn affects every other rate. This is done under the open market economics, instead of a mechanism where private sector would heavily participate in the determination of interest rates. The state, the Zambian government, is the reason behind these high interest rates. We've made it a mistake to offer a lot of very attractive treasury bills. Government in this action has made itself the main player in the financial market, putting the private sector in the shadow. Commercial banks have become lenders to the government instead of lending to the private sector. In response to this action of government securities being offloaded onto the market, attracting commercial banks into purchasing these securities, the banks will reduce their lending to the private sector. Hence, the available loanable funds to to the private sector will reduce. Government securities are seen as risk-free investments. In this situation, our commercial banks categorize the private sector lending as high risk. Banks generally will charge a high-risk borrower at a high interest rate to cover up for the anticipated risks. However, our advice to the commercial banks is that they should reduce their interest rates. Commercial banks should now engage in the modern hedging techniques against the risks involved when lending to the private sector. In conclusion, government should spend more and more instead of borrowing more and more from the banking sector. This will enable commercial banks to shift their priorities in lending to the private sector instead of lending to the government in the form of treasury bills. What we will see through this mechanism is that our nominal interest rates will adjust downwards. When we lend more and more to the private sector, then we'll have an expansionary monetary policy effect, bringing in the desired